Good morning, hunters, and welcome back to the Daily Hunt from Multibaggers. It's Tuesday, October 28th, 2025, and we're diving deep into the market data collected yesterday.
That's right, Ethan. Our AI engine has been buzzing, sifting from a truly massive amount of chatter this time around. We flagged quite a few different stocks with some very strong polarized opinions out there.
Absolutely, Brooke. There's a palpable sense of excitement for growth in some sectors, particularly around AI and some of the big tech names. The community sentiment is, really leaning into that future potential.
And on the flip side, we're seeing some serious red flags and concerns about fundamentals, which of course means risk management needs to be front and center for our listeners. Let's get right into it.
All right. First up, let's talk about Apple Inc., AAPL. Our data indicates a strong bullish sentiment. We're seeing Apple heavily investing in its Vision Pro platform, and there's robust iPhone demand coming out of China and India. JP Morgan even raised their price target to $290 from $280. This looks like a solid growth story.
Well, Ethan, while the news is indeed positive and the stock is near its 52-week high, let's look at the numbers. Its PE ratio is still sitting at a relatively high 39.82, while revenue growth is positive at 0.096 and net profit margin is healthy at 0.24. That high PE does suggest that a lot of future growth is already priced in. However, the analyst target gives some runway.
Last time we looked at Apple, it was a buy on October 22nd. And before that, it swung from stay away to buy. It seems like the market is finally recognizing its continued innovation.
Given the strong current momentum and renewed analyst confidence, I'd agree it's a buy for now, but certainly want to watch closely around those Q4 earnings on October 30th. Next, we have Novo Nordisk ADAS NVO. This one's a bit of a mixed bag in terms of user sentiment, Ethan. We saw a lot of optimism around their new weight loss pills, with users calling it undervalued and anticipating strong Q4 market entry. But then there were also users reporting significant losses, saying, "I'm here to lose money," and so far, mission accomplished.
Yeah, it's interesting, Brooke. That bullish argument centers on them being first to market with highly effective weight loss pills and comments about cleaning house with a new CEO. It's a compelling future narrative. Plus, the current price is significantly below its 52-week high of 113.76, making some feel it's a bargain.
But let's remember, undervalued doesn't mean no risk. The current price is $52.89, much closer to its 52-week low of 45.05. While revenue growth is 0.129 and net profit margin is strong at 0.356, the next earnings are November 5th, and some users were explicitly expecting missed earnings. That's a big event.
That's fair. The market has certainly beaten it up, but the long-term fundamentals and the potential impact of those new drugs.
Our AI-generated analysis concludes buy for NVO, primarily because the financial fundamentals like strong revenue growth and profit margins, combined with the significantly depressed price compared to its 52 high, could present a long-term value opportunity.
Shifting gears to Robinhood Markets Inc., HOOD. We saw some neutral to slightly bullish buzz, particularly around a potential collaboration with another mentioned stock. The poster seemed to think it was a good setup.
Ethan, I'm going to have to pump the brakes on Hood. While there are mentions of product innovation and robo-advisor success, the KPIs are screaming caution. We're looking at a PE ratio of over 70 and a price-to-book ratio of 16. That's exceptionally high valuation.
But the revenue growth is solid, 0.45, and net profit margin is excellent at 0.50. They're making money and expanding.
They are, but that high valuation is paired with a very concerning debt-to-equity ratio of 161.17 and a beta of 2.43. That means it's highly volatile and heavily leveraged. Any slight misstep and that high valuation could come crashing down. Our AI-generated insights conclude we should stay away from Hood. This maintains its previous stay away rating from October 23rd.
Next up, Amazon.com, Amazon. We had a mix of assessments today, but several posts, including one celebrating Uptober gains, pointed to strong bullish sentiment. Amazon's also pushing innovation with Amelia smart glasses and seeing huge growth in India exports. Analysts like Stifel and Benchmark are maintaining buy ratings.
Look, I get the excitement, Ethan, but even with positive revenue growth of 0.133 and a decent net profit margin, the underlying KPIs for AMZN present significant risks. We're talking about a PE ratio over 34, which is high. More critically, the debt-to-equity ratio is 47.80, indicating substantial reliance on debt. Also, let's not forget the news about cutting up to 30,000 corporate jobs. That introduces a lot of uncertainty.
But the user sentiment for Amazon was strong, with mentions of it being a good company and calls for a breakout.
I respect the bullish community perspective, but the financial leverage and high valuation, coupled with the job cuts, make it risky right now. Our AI-generated analysis suggests to stay away from Amazon at these levels. This reflects a downgrade for some of its previous buy ratings, like the one on October 25th.
All right, let's talk Qualcomm Incorporated, QCOM. The sentiment is overwhelmingly bullish. Users are celebrating 900% gains, and there's chatter about QCOM being undervalued with potential to grow to 298. They've just debuted new AI accelerator chips, entering the AI chip race, and analysts are raising price targets. This is a strong momentum play, Brooke.
Ethan, the excitement around Qualcomm is undeniable, and it's great to see that recent jump. Revenue growth is positive at 0.103, and the net profit margin is very healthy at 0.267. But while the PE of 16.32 is relatively modest for a tech company, the beta is 2.43, indicating it's quite volatile. We need to be mindful of that.
Agreed on the volatility, but the overall picture with those new AI chips and analyst upgrades, it screams potential. This is a first-time mention for QCOM, and the AI-generated insight says it's a buy.
Moving on to Align Technology Inc., ALGN, I'm afraid the picture here is pretty grim. The community sentiment is predominantly bearish, with users explicitly calling it old, outdated tech with patents long expired. A dentist even characterized it as a bad investment. We're seeing multiple analyst price target reductions and comments from Jim Cramer about a lot of forces against the company.
Yeah, that's rough. I did see a user who was long and mentioned a 12 forward PE as a positive. There are some believing in the underlying product quality and potential rate cuts.
But Ethan, the KPIs are brutal. Revenue growth is negative 0.016, and the current price is dangerously close to its 52-week low. The debt-to-equity ratio is 3.144, which is high, and a PE of almost 23 with negative revenue growth just isn't attractive. Our AI-generated analysis strongly suggests to stay away from ALGN. This is a new rating for them.
Now for Meta Platforms, META. This one is looking very bullish. We're seeing strong Q3 revenue exceeding expectations, driven by their AI glasses and wearables. They're actively developing Aria Gen 2 AI glasses, and analysts are pounding the table on Meta, with Jim Cramer noting great quarter after great quarter. The financials for Meta are indeed impressive, Ethan. Revenue growth is 0.216, net profit margin is a whopping 0.399, and return on equity is 0.406. These are top-tier numbers, reflecting strong profitability and efficient management. The current price is also near its 52-week high.
With that kind of performance and innovation in AI and wearables, it's hard to argue with. The AI-generated analysis for Meta is a clear buy. This maintains its buy rating from October 22nd.
Up next, Alphabet Inc., Google, another tech giant with overwhelmingly bullish sentiment. Google just announced a breakthrough with its Willow quantum computing chip, and Google Photos is getting immersive features. Wall Street is pounding the table on GOOG, and users are even suggesting it's headed to NVDA market cap.
Ethan, the operational metrics for Google are undeniably strong. Revenue growth of 0.138, net profit margin of 0.311, and an excellent return on equity of 0.348. The current price is also near its 52-week high, showing robust momentum. However, let's note the debt-to-equity ratio of 11.48, which, while not crippling, is something to monitor.
For a company with this kind of innovation, profitability, and analyst support, those numbers are well justified. The AI-generated analysis on GOOG is a strong buy, maintaining its rating from October 25th.
Let's turn to Beyond Meat Inc., BYBN. Ethan, this one is unequivocally bearish. The posts are filled with stories of significant losses, with one user reporting over 125,000 USD loss. Comments are advising to sell the share and calling it a pump and dump with no turnaround fundamentals.
Ugh, that's a tough read.
The KPIs confirm the distress. Revenue growth is negative 0.196, net profit margin is negative 0.509, and EPS is negative 1.77. The price-to-book ratio is also negative, meaning liabilities exceed assets. This isn't just a dip, it's a fundamental problem.
Yeah, when the community is talking about fake meat shares and bag holders, it's not a good sign.
Absolutely. Our AI-generated analysis concludes a firm stay away for BYBN. This maintains its stay away rating from October 27th.
Now for United Health Group Incorporated, UNH. We saw some mixed signals here, Brooke. While one post was skeptical of a leveraged earnings bet, other users were bullish on long-term holding, citing expectations for earnings beats and positive political factors. There was even a positive technical assessment.
Ethan, while some users might be optimistic about a long-term hold or dividend yield of 2.44%, the overall picture, especially around highly leveraged bets, carries huge risk. The current price of 365.98 is significantly below its 52-week high of 630.73. And crucially, its debt-to-equity ratio is a high 75.577. An analyst even questioned if it's attractively priced.
So despite some of the positive sentiment about climbing like it did in the old days?
Yes, despite that, our AI-generated insights for UNH point to stay away for now. This would be a downgrade for some of its previous buy ratings this month.
Okay, let's talk about NVIDIA Corporation, NVDA. Here we had some very strong bullish sentiment from users, with one post talking about NVDA having an equity stake in a promising company and others highlighting its market leadership. There's chatter about new street-high price targets.
Hold on, Ethan. While NVDA certainly has strong revenue growth at 0.556 and a fantastic net profit margin of 0.524, the valuation concerns are enormous. The PE ratio is over 53, and the price to book is over 46. This stock is priced for perfection. Plus, there's significant new competition from Qualcomm entering the AI chip race, which could challenge NVIDIA's dominance. And with a beta of 2.123, it's highly volatile.
Right, but the user who successfully traded it from 179 to 190 showed short-term profit.
The comments mostly attributed that success to a general raging bull market and massive leverage, not necessarily NVIDIA-specific undervaluation. Given the extreme valuation multiples, the increasing competition, and high debt-to-equity, our AI-generated analysis suggests to stay away from NVDA. This marks a downgrade for its recent buy ratings, for instance, on October 25th.
Next up is Gladstone Commercial Corporation, Good. What's the read on this one, Brooke?
Unfortunately, Ethan, our AI could not discern any direct user sentiment on Good from the provided data. The mentions of Good were actually referring to AMD's performance. However, looking at the KPIs, it's a pretty clear picture. We're looking at an incredibly high debt-to-equity ratio of 231.009. The current price is also very close to its 52-week low.
So despite a 10.47% dividend yield, the fundamentals are a concern.
Absolutely. That PE ratio is still over 30, and news suggests limited catalysts. With such high debt and limited upside, our AI-generated analysis concludes stay away for good. This is a new rating.
All right, let's talk about Nebius Group, NBIS. The sentiment is pretty bullish. Users are predicting a $400 stock in the making and a skyrocket after upcoming earnings, thanks to a huge Microsoft contract and revised AR guidance. Users are riding with you to Valhalla.
Ethan, that community optimism is, well, optimistic, but the KPIs are stark. The PE ratio is an astonishing 162.89. Its operating margin is negative 1.058, meaning it's losing money on its core operations. And the debt-to-equity ratio is an extremely high 32.427. While it's seen massive price appreciation from its 52-week low, these are serious red flags about fundamental financial health.
So despite the hype and the major event for Nebius Group NBIS stock that Jim Cramer mentioned?
Yes, despite the hype, the financial risks are too high. Our AI-generated analysis for NBIS indicates stay away. This marks a downgrade from its cautious buy rating on October 27th.
Let's move on to Microsoft Corporation, MSF. This looks like a very strong buy, Brooke. They've signed a $17.4 billion contract for AI infrastructure, cementing their position as a hyperscaler. Analysts like TD Cowen, Arete Research, and HSB are raising price targets, and Jim Cramer expects a great quarter.
Indeed, Ethan. Microsoft's financials are top-notch. Revenue growth of 0.181, net profit margin of 0.361, and return on equity is 0.332. The current price is near its 52-week high, which typically shows strong confidence. While the PE ratio is 38.91, for a company with this kind of growth, profitability, and strategic direction in AI, it's justifiable.
With earnings due on the 29th, that AI contract is huge for future growth.
Absolutely. Our AI-generated analysis for MSF is a firm buy. This maintains its buy rating from October 24th.
Okay, let's tackle Advanced Micro Devices, Inc., AMD. The sentiment here is, well, enthusiastic. Posts are titled, AMD saved me from precious metals, and users are regretting selling it at 20, 102, even 163, as it went vertical. There's talk of a $1 billion partnership with the U.S. Department of Energy for AI supercomputers, and some are asking if it could be the NVIDIA of 2026.
Ethan, I'm going to interrupt the celebration. While that community sentiment is incredibly bullish, AMD's KPIs paint a concerning picture. We're talking about a PE ratio of over 150. That is an astronomical valuation, suggesting extreme speculation. What's more, the operating margin is negative 0.012, meaning they're losing money on their core business operations. And the debt-to-equity ratio is a high 6.513.
Yeah, but the revenue growth is still positive at 0.317, and it's powering sovereign AI supercomputers. That's cutting-edge stuff. It is, but the stock is also at its 52-week high, and new competition from Qualcomm is entering the AI chip market. The financials simply don't support this kind of valuation or risk profile. Our AI-generated analysis strongly recommends to stay away from AMD. This maintains its previous stay-away rating from October 25th. Time for UiPath, Inc., PAT. The sentiment here is bullish, Brooke. Posts are celebrating Path 100% gain and predicting $20 by year-end. Users are holding call options for 2027, seeing good momentum. There was even a partnership announcement with NVIDIA.
Ethan, I really need to highlight the risks with PAT. Despite the community's enthusiasm, the KPIs are alarming. The PE ratio is a staggering 579. That's an extreme overvaluation relative to its minimal EPS of 0.03.
But revenue growth is 0.144.
Yes, but the operating margin is negative 0.0519, meaning they're losing money on their core business. And the debt-to-equity ratio is 4.61. This company has weak fundamentals and relies heavily on debt. The NVIDIA partnership news was also widely considered old news and already priced in by the community.
So even with the strong community optimism?
The risks outweigh the hype, in my opinion. Our AI-generated analysis for PAT is to stay away. This maintains its previous stay-away rating from October 27th.
How about Open Door Technologies, Inc., OPEN? We had strong bullish sentiment, with one user betting $190K and anticipating Fed rate cuts to boost the housing market.
That's a classic example of community optimism, Ethan. But our AI-generated analysis concluded stay away. Despite the positive outlook from some users, the KPIs are deeply concerning. Net profit margin is negative 0.05, EPS is negative 0.44, and the debt-to-equity ratio is an extremely high 346.117. The company is simply not profitable and is heavily leveraged.
This maintains its stay away rating from October 25th. All right, let's talk about OpenAstrive Inc., AST. This one saw some strong YOLO bullish sentiment, with users holding thousands of shares and targeting 10 to 15 by December, calling it a blessing. There's positive buzz about its Bitcoin treasury model.
Yes, there's certainly a passionate bullish crowd, Ethan, but there's also significant skepticism, with users questioning if it's same pump dump like buy-end and noting its penny shit status. The KPIs are stark. EPS is negative 0.04 and the net profit margin is 0. Even more critically, the price-to-book ratio is negative 16.23. This means liabilities exceed assets. It's fundamentally unsound.
So despite the strong community conviction in its Bitcoin-related business?
Our AI-generated insights for AST indicate stay away. The financial health is too precarious. This maintains its previous stay-away rating from October 27th.
What about IREN Limited, IREN? We saw some discussion about their infrastructure as a service model.
This one was neutral on user sentiment, Ethan, as the mentions were more descriptive than emotional. However, the KPIs are a concern. Its PE ratio is a very high 166.66. While revenue growth is strong at 2.233, the beta is an extremely high 4.199, indicating wild volatility. The stock has already seen a wild 501% rally in 2025, so a lot of that upside might be priced in.
So a lot of potential, but a lot of risk, too.
Precisely. Our AI-generated analysis concludes stay away for IRN. This maintains its previous rating from October 24th.
Next, Rigetti Computing, Inc., RGTI. Any thoughts here?
Well, the only direct mention was a user successfully shorting RGT for a $40,000 profit, which is a bearish indicator. The KPIs are equally bearish, Ethan. Revenue growth is negative 0.416, EPS is negative 0.91, and the operating margin is negative 11.03. It's unprofitable and shrinking. The price to book is also high at 23.5 for an unprofitable company.
So despite it being in the quantum computing sector, which is, futuristic,
Future tech doesn't guarantee current profitability. Our AI-generated analysis suggests to stay away from RGT. This maintains its previous rating from October 25th.
And finally, MP Materials Corp. I know there's a lot of talk about rare earths.
Yes, and the sentiment is quite bearish, Ethan. We saw a pre-market drop of 6%, and users are calling it wildly overvalued with literally no earnings. Many believe the FOMO/pump hype is over. The KPIs confirm this. Net profit margin is negative 0.418, EPS is negative 0.58, and operating margin is negative 0.768. The price to book is also high at 10.6 despite these heavy losses.
So even with the strategic importance of rare earths for the U.S.?
The financials are too weak and the valuation too high. Our AI-generated analysis for MP is a stay away. This is a new rating.
All right, let's wrap up our daily hunt. After all that analysis and spirited debate, here's our compiled list for deeper consideration. Investigate as buy. Apple Inc., AAPL, Novum Nordisk AS, NVO, Qualcomm Incorporated, QCOM, Meta Platforms, MCB, Alphabet Inc., GOOG, Microsoft Corporation, MSFT. Investigate as cautious buy. None. Investigate as speculative gamble. Nebius Group NV, NBIS.
And that brings us to the end of today's Daily Hunt.
Remember, this podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice.
Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses.
The market is a wild place, and knowledge is your best asset.
Thanks for tuning in, everyone. We'll be back tomorrow with more insights from the Daily Hunt.
Happy hunting, and we'll talk to you then.